Welcome to The Interest. I'm Sarah Wolak. Happy Monday! To kick things off, we have Master the Markets featuring Bill Bodnar, which will give us a glimpse into how federal debt is playing into the mortgage business. But first, it looks like rate locks remained relatively flat as rates ticked up in July. And it appears that ICE and Black Knight have finally made significant progress in their settlement negotiations with the FTC. Stay tuned for more details.
My name is Thomas Hall. I went ahead and used the Southwest AI app, and I put in a difficult loan scenario with some tax returns and everything, and I had somebody else already underwrite it. When it came back, it was almost identical within like a few dollars, and it took about 30 minutes instead of a whole day or two for somebody to analyze that. So yeah, that AI is going to be the best thing in the whole industry. So stay tuned.
Welcome back. Mortgage Capital Trading reported that rate lock activity was pretty flat throughout July, edging up less than 1%. That being said, year-over-year numbers paint a different picture. MCT says that total lock volume is down roughly 13%. They point to rocky roads ahead, including the Fed raising federal funds rate and Fitch's recent downgrade of U.S. debt. After a long legal battle, it looks like the FTC has finally allowed Intercontinental Exchange to acquire Black Knight. The FTC had previously cited concerns about decreased competition in the mortgage industry and higher consumer costs. The joint stipulation dismisses the federal court complaint, which will allow the entities to work towards a final settlement agreement. Coming up, Bill Bodnar shares what market signals may impact the industry.
Don't miss the largest mortgage show in the nation. The Originator Connect returns to Planet Hollywood in Las Vegas August 17th to the 20th. See us at originatorconnect.com. Find the best connections in the industry, dozens of sessions, scores of exhibitors. It's where success is written every hour. originatorconnect.com.
Hey everybody, thanks for tuning in to our Master the Market segment. This week it is all about debt. Earlier this week, the Treasury Department had their forecast for funding needs for the months of August through October, and they came out and said we need $1 trillion. That was $275 billion more than what was forecast back in May. So the bond market didn't like it, stocks didn't like it, yields spiked. But if that were not enough, on the heels of that announcement, looking for more money, Fitch Ratings, bond rating firm, came out and downgraded U.S. debt one notch. And it's material. Last time it happened was back in August of 2011. So that sent rates spiking further. And for us in the mortgage business, we've been watching 409 on the 10-year note as a yield. That was stopping yields from moving higher. Here we are on a Thursday and we're piercing above it. That could be a very, very telling moment, because if we go beyond 409 for a couple days, we're probably going to revisit the peaks back in October and November. Not a good sign. So now, as a mortgage professional, we have to watch the charts, we have to watch inflation, we have to watch the labor market. Now we have to add one more thing: debt and the problems associated with it. And so, listen, I know there are better days ahead. I do hope this finds you well. Next week, we do have the CPI number, and that'll be an important print, because last month's reading, remember, that came out at 3%, way off the 9% of last June. If that comes in cool, we can get some relief, but obviously the opposite is true. Have a great weekend. We'll talk to you soon. Bye for now.
Thanks, Bill. For more on these and all of today's top stories, visit nationalmortgageprofessional.com.